The United States of America owes $31,456,145,228,000. This means the average American owes $94,283 in debt. That's a steep hill to climb on the road to financial freedom. But is it possible to use debt to generate wealth? How so? Join us as we discuss how to use debt to generate wealth. Most of the debt of Americans is made up from debt from credit cards, personal loans, mortgages, auto loans, and student loans. But it's important to note that debt has a broader definition that, when properly understood, can be leveraged to generate income. So, how may debt be managed for financial gain? Well, we'll be explaining exactly that in today's video, but first, please like this one and subscribe to our channel for more great videos. Now, we said the entire nation owes $31.4 trillion, but how do banks generate income to finance loans? Let's start by taking a look at a simple illustration. Jane is registered in a pension plan by her company and is now worth $30,000 in the bank. Let's say she earns 2% interest on her savings annually. A year later, she earns $600 on her savings, which would be paid by the bank. Let's say Cindy has college debt of $40,000 at an interest rate of also 2%. That's $800 extra she pays to the bank. From these two transactions, you can see that the bank makes $800 but loses $600, leaving them a net gain of $200. This is how gigantic financial institutions are built, easily generating billions of dollars in revenue. Therefore, if banks can profit by lending out other people's money, so can people like you and me. A basic understanding of financial management, financial instruments, and the financial market when one plans to conduct business is all that is necessary. Good debt versus bad debt. First, we need to understand the difference between good debt and bad debt. Good debt. Any debt that helps you reach your financial objectives is a good debt. So if you take out a personal loan from a bank to combine your high-rate bills, and if doing so enables you to pay it off in full without hurting your credit score, that debt would be a good debt. Another acceptable debt example is taking out a personal loan with, say, a 3% interest rate and investing the money in equities that yield a 7% return. As a result, your net return would be 7 minus 3 or 4%. Bad debt. But any sort of debt that ultimately lowers your credit score and puts you under more financial strain is referred to as bad debt. People who have bad debts wind up causing more bother than they're worth and miss their financial savings goals. But there is another to keep in mind: your risk threshold. Risk threshold. Gaining knowledge of the risk to reward connection is crucial if you want to build money. The relationship between risk and reward is straightforward. Risk and rewards are directly inversely correlated. The greater your risk, the greater your return. Junk bonds have high rates of return because of this. Because they are trash bonds which have a high default risk, a high rate of return is provided to investors to make up for the high risk. Little return, on the other hand, comes with low risk. Treasury bonds are a good example. They are regarded as zero-rated or very low-risk bonds, and as a result, their rate of return is quite low. This association is crucial for every investor to comprehend, since it forms the basis for making investing decisions. To start, you must assess your own risk tolerance. Are you someone who seeks out risk or someone who avoids it? Your financial security and long-term financial objectives will determine the answer to this question. Your risk appetite is probably going to be risk-seeking if you are stable and have high ambitions. As a result, you are more prone to choose riskier investment strategies. However, if you're not yet financially solid, it makes sense to assume that you have a low risk tolerance. When you aren't already financially secure, there's no use in making dangerous choices. So far, we've covered 3 important financial investment topics: good versus bad debt, the relationship between risk and return, and how to gauge your risk tolerance. As we examine how to make money from debt, keep these in mind. This is how you make money off debt. Margin trading. Margin trading is the first method of profiting from debt. What is margin trading exactly? It may sound complicated, but allow me to explain. Margin trading simply refers to the practice of borrowing money to trade on the market and using the proceeds from your trades to repay the loan. So let's take a closer look at this. Imagine you're a trader and you have $10,000 in your trading account. It would be perfectly acceptable for you to use this money to trade. However, as a trader, what you will do is create a margin trading account if you want to profit from debt. This will enable you to borrow money up to the value of your trading account, or a portion of it. To put it another way, if you have $10,000 in your trading account, your broker may be able to lend you an additional $10,000, bringing your total account balance to $21,000. If you are receiving a 4% return on $10,000, your return will increase to $20,000. You can pay off the margin loan and create a net profit if you trade profitably and successfully. Even though margin trading appears to be straightforward, there are certain restrictions. For one, it might be addictive. If you get the hang of trading, you could become overconfident and put an excessive amount of money on the line. Since it resembles gambling somewhat, it's important to recognize your boundaries. The best method to be aware of your boundaries is to have your risk tolerance and financial objectives in mind at all times. Another important point is you must be knowledgeable about the market and the securities you will be trading in. One of the reasons many margin traders lost their fortune during the Great Depression was because they were too leveraged and unable to predict the recession. You might also try making money through personal loans if margin trading is too risky for you, but you need to have a strong or great credit score for this to work out. If not, the interest rate that is being offered to you will be too high for you to obtain a respectable return. Use that money to invest in a business or a profitable investment alternative if you're able to secure a low-interest personal loan. Good debt, remember? Depending on how much money you're willing to put in, there are different profitable investment choices. Another low-risk investment choice is index funds. In essence, these are mutual funds that follow any index, including the Dow Jones, FTSE, and S&P 500. The risk is low and returns closely mirror those of underlying index because the index tracks the portfolio of the index it is monitoring. For example, by investing in 2020 in an index fund that follows the Nikkei, investors benefited from the over 25% return on the Japanese stock market. A 20% return based on a loan with a 4 to 5% interest rate is not at all terrible, and an investor may have received a return of roughly 20 to 25% in any particular year. Your net return would have been close to 15%, which is extremely good given the state of the markets then. Also, take note of real estate. Real estate investing is an additional choice and probably the one you've all been looking forward to. In my opinion, buying real estate is the best way to pay off debt because you're essentially purchasing an asset worth hundreds of thousands of dollars with only a tiny amount of your own money as down payment. If you obtain an FHA loan in the United States, this may occasionally be as low as 3.5%. Let's examine an illustration. Let's say you put 3% down to buy a $400,000 home. This indicates that even though you only had to put down $12,000 of your own money, you suddenly owned a $400,000 asset. Now, if the house increases in value by 5% during the next year, you will have earned a handful of cash. Do the math. So simply by staying in your own house for a year, you can more than double your money. Now, consider if you had several properties, or if you refurbished one of them to raise its value even further. When investing in real estate, you can see how effective borrowing money may be. It's for this reason that a large number of investors believe it to be the ideal sector in which to invest. Would you rather borrow money to invest, or would you prefer to spend the funds you already have without borrowing additional money? Let us know in the comments section below. As always, I hope you enjoyed today's video, and I'll see you in the next one.